One of the biggest differences between cryptocurrency and the traditional financial system is that cryptocurrency is transparent. All wallets, balances, and transactions are publicly viewable by anyone. This transparency has made it possible to do elaborate on-chain analysis that can reveal some very valuable information, and Chainalysis recently released a report with no shortage of such info. Today, I'm going to give you a bit of background about Chainalysis's report, summarize what it says in simple terms, and tell you what it could all mean for the crypto market. Before we explore the blockchain, there's something I need to explain. If you're here for financial advice, I'm afraid that's not something you'll obtain. Education and entertainment are the only things this video contains. Please contact a financial advisor if your portfolio is looking lame. Now, if this is the first time you see this bloke, my name is Guy, and some call me the Crypto Pope. I create crypto content whose quality is so high you can almost see the green smoke. Coins, tokens, news, and reviews are just a few of the topics I have for you to toke. If you're already stoked, subscribe to the channel and ping that notification bell for more crypto dope. Okay, that's enough of the intro jokes. Let's look at this report and what it means for us crypto folk. If you've never heard of Chainalysis before, here's what you need to know. Chainalysis is the biggest blockchain analytics company in cryptocurrency, and its job is to track cryptocurrency transactions, mostly for the purposes of regulatory compliance. Chainalysis claims it can track almost every cryptocurrency out there. The company is based in the United States and it's been around since 2014. It has over 500 clients, including most cryptocurrency exchanges, and has also worked very closely with governments around the world, most notably the US government. Now, this might lead you to believe that Chainalysis is anti-crypto, but this doesn't seem to be the case at all. Besides holding BTC on its corporate balance sheet, Chainalysis co-founder and chief strategy officer Jonathan Levin has testified to US politicians in defense of cryptocurrency on many occasions. Chainalysis being the biggest blockchain analytics company also means that it has become the de facto source of truth when governments have questions about cryptocurrency. And let's just say it seems to be more lenient in its transaction tracking compared with other blockchain analytics companies. On that note, you can find out exactly how they track transactions by watching our video about the biggest blockchain analytics companies, which will be down in the description. Now, in addition to helping public and private institutions keep track of crypto transactions, Chainalysis regularly provides in-depth research reports, which can provide some extremely valuable information about specific cryptocurrencies and the crypto market as a whole. Today's research report is titled, quote, The Chainalysis State of Web3 Report, which gives an overview of the current state of cryptocurrency. The report was released at the end of June, and I'll leave a link to the full text in the description if you're interested. Note that you'll have to enter some personal information to access the report. Blockchain analytics companies, eh? All right, enough jokes for one day, I say. Sit back and relax while I unpack this crazy crypto report. As always, I'll give you my thoughts as we go along. The Chainalysis report begins with a brief introduction where the authors argue that all companies will eventually become crypto companies and users will access their services using browser extension wallets like MetaMask. What's odd is that the authors note that around 8% of Americans hold cryptocurrency, which is far off from the 20% statistic given during a recent hearing about the future of crypto regulation in the United States, which we covered in another video. That'll be in the description, of course. The authors then talk about how crypto will make it possible to cut the middleman out of the equation, notably middlemen who make important decisions, such as who gets to have a mortgage. The authors explain that algorithms will decide this automatically instead, and I'm not so sure how I feel about that. The authors also explain how crypto will make it possible for users to own and have a say over the services they use with tokens and decentralized autonomous organizations, or DAOs, which they see as expanding to other crypto niches outside of DeFi, before going mainstream. When it comes to on-chain trends, the authors note that there continues to be lots of interest in DeFi despite the crypto bear market, that most transaction volume is coming from smart contract cryptocurrencies, and that most of these transactions are related to stablecoins. As you can see, the smart contract-related activities that are attracting the most transaction fees and transfers are decentralized exchanges, borrowing and lending protocols, NFTs, infrastructure-related protocols, and, to a lesser extent, DAOs. Whereas DeFi protocols and DAOs are typically attracting experienced crypto users and investors, NFTs seem to be the gateway into crypto for new and inexperienced users and investors. The authors know this because the wallets interacting with NFTs tend to be much newer. Neat stuff. The authors end the introduction by calling on the crypto community to do 3 things. Get as many new users into cryptocurrency as possible, make decentralized applications and browser extension wallets used to interact with them more user-friendly, and focus on stuff like NFTs that's easy to grasp. Challenge accepted. Now, the first part of the Chainalysis report concerns the largest Layer 1 cryptocurrencies, and the authors begin by explaining that Layer 1 cryptocurrencies are those which are used to pay transaction fees on their respective blockchains, so BTC for Bitcoin, ETH for Ethereum, and so on. Speaking of Ethereum, the authors talk all about the adoption it has seen from both users and developers, and correctly point out that Ethereum's slow transaction speeds and high fees have resulted in the creation of multiple so-called Ethereum killers, including Solana and Algorand. What's annoying is that the authors say Solana uses proof of history as its consensus mechanism, which isn't technically correct. If you watched our video about crypto consensus mechanisms, you'll know that proof of history is a part of Solana's proof of stake consensus mechanism. Take notes, folks. The authors then pivot to comparing Bitcoin, Ethereum, and Algorand, which is a peculiar combination to say the least. That's because Algorand hasn't seen nearly the same amount of adoption as the first 2, and the image here says it all. It's the number of unique active wallet addresses on each blockchain. At first, I thought this peculiar combination was because Algorand might have sponsored the report, but apparently that's not the case. As such, I suspect that it might just be the bias of the author, or possibly a subtle sign that Algorand is a much bigger deal than most crypto holders believe. Take notes indeed. Now, the authors found that large institutions have the biggest presence on Ethereum, that smaller institutions have the biggest presence on Bitcoin, and that professional investors have the biggest presence on Algorand. The authors also found that institutional interest in Bitcoin has remained the same over the last year or so, whereas it has declined slightly for Ethereum and declined significantly for Algorand. Again, this makes me wonder why this trifecta of coins was chosen. Not to go off on too much of a tangent, but the authors note that the institutional interest in Algorand started to decline sometime in September. This happens to be around the time that Algorand's accelerated vesting ended. You can learn more about that using the link in the description. Anyways, the authors then turn to discussing the problems with Ethereum, and this is where they make another minor mistake. The authors note Visa can process 1,500 transactions per second, when Visa can actually process closer to 65,000 transactions per second, as per its own fact sheet. I suspect that 1,500 figure comes from the fact that Visa processes an average of 1,500 transactions per second on any given day, which is obviously nowhere close to the number of transactions per second the Visa network can actually handle. I digress. Now, aside from scalability, the authors take issue with Ethereum's high transaction fees, which are, quote, virtually always at least 20% or more of the transaction cost. The authors note that the only time Ethereum transaction fees compete with legacy payment networks is when the amount of crypto being sent is more than $500, in which case the transaction fee accounts for around 4% of total transaction on average, which is equivalent to most credit cards. The authors also argue that Ethereum's EIP 1559 upgrade hasn't done nearly enough to increase the predictability of transaction fees, something the upgrade was supposed to do. They provide tables for Ethereum transaction fees before and after EIP 1559 as proof, and, well, fair enough. The authors then discuss a few Ethereum competitors, starting with Solana. Here, they correctly note that proof of history is part of Solana's proof of stake consensus. Whew, had me worried there. What's interesting is that it appears the authors reached out to Solana's developers to confirm its transaction speed, and the developers specified, quote, transactions per second generally between 1,500 and 3,500, with a maximum of 65,000 depending on transaction complexity. This suggests that Solana's max smart contract transaction speed is lower than 65,000, which makes sense, and something I'll be sure to discuss when we cover Solana again. You can find our most recent update about the project in the description. Anyhow, what's also interesting is that the Solana developers told the authors that the number of daily active users on Solana has increased by 40% over the last 3 months, which either means that Solana is handling the crypto bear market very well, or that Solana simply saw a temporary resurgence in users. The second Ethereum competitor the authors cover is, again, Algorand, and what's funny is the only thing they really say is, quote, most transaction volume for Algorand is moving through big centralized exchanges, but its staking rewards pool also sees significant activity. The third Ethereum competitor the authors cover is BNB Chain, formerly known as Binance Chain. The authors note that, quote, BNB Chain can't be said to be fully trustless in the technical sense, as it's maintained by a centralized, legally incorporated business entity, which is, of course, Binance. This is something we mentioned in our recent BNB update, and the authors also point to the fact that much of BNB's supply is held by the Binance team as evidence of centralization, something we also mentioned in our recent BNB update. That is, of course, in the description, by the way. The fourth Ethereum competitor the authors cover is Avalanche, and after explaining how it works, the authors note that most dApps on Avalanche are related to DeFi, something which ultimately resulted in AVAX getting hit hard by Terra's collapse. More about that in the description too. The authors end this section by claiming that Ethereum is unlikely to be dethroned as the biggest smart contract cryptocurrency anytime soon, and even claim that the current crypto bear market could kill off most, if not all, of the so-called Ethereum killers, despite all the investment they've received. Bold claim. The second part of the report concerns digital identity, which is a term that makes many crypto holders uncomfortable, including myself. The thing is that there's such a thing as a decentralized digital identity that allows users to maintain control of their identity and is therefore much less dystopian. This seems to be the angle the authors take when they talk about how browser extension wallets like MetaMask could become de facto digital identities in the future economy. They also talk about Ethereum name service and the immense value of its human-readable wallet addresses in this context. The authors note that over 1.1 million ENS domains have been registered by over 400,000 unique Ethereum wallets, and as you can see, most of these ENS domains were registered in just the last couple of months. The authors also applaud ENS's integrations with the ICANN registry and IPFS. Now, I honestly expected a bit more from this section, especially since decentralized digital identities will be extremely important for cryptocurrency's evolution. I was also expecting to see something about the soul-bound NFTs proposed by Ethereum creator Vitalik Buterin. More about those in the description. Anyhow, the third part of the report concerns DeFi, and here the authors begin by examining the exponential adoption of decentralized exchanges, or DEXs. As you can see, DEXs surpassed centralized cryptocurrency exchanges, CEXs, by transaction fees in early 2021 and have maintained their lead since then. Not surprisingly, the authors found that transaction volumes on DEXs and CEXs are closely related to the current state of the crypto market, with pumps resulting in more transaction volume and vice versa. The authors note that sexes have held up much better during the recent slump, which is also not surprising. The authors also note that 85% of all DEX transaction volume is coming from just 5 DEXs, which is, once again, not all that surprising, though it is annoying that the authors don't specify which DEXs these are. It's a similar story for sexes, with 50% of all sex trading volume coming from the top sexes. Now, get your minds out of the gutter, guys. This is crypto, not Amsterdam. Now, the authors take this discrepancy as evidence that the DEX game seems to be more of a winner-takes-all arrangement, and they suspect that this might have to do with the lack of liquidity in the crypto market. Obviously, nobody wants to trade on a DEX with lots of slippage, so users stick to the same ones. The authors then measured the profitability of providing said liquidity on these DEXs for users to trade with, and what's frustrating is that they don't specify how much the average LP has been earning. Just the total amount for all LPs, which has, quote, fluctuated between $50 and $100 million. The authors end this section by speculating on whether DEXs will continue to lead in terms of transaction fees, and they argue that it all boils down to 3 things: whether DEX fees can stay low, whether they can survive regulations, and whether they can convince investors that they're super safe. Now, as many of you will know, surviving regulations is code for becoming fully decentralized, and you can find out exactly what that means using the link in the description. Moving on. The 4th part of the report concerns DeFi again, but this time the authors focus on lending and staking. A footnote on this page specifies that this section doesn't have to do with centralized lending and staking with platforms like Celsius. That part comes later. What's odd is that the authors include staking on proof-of-stake cryptocurrencies in this section, even though it's not exactly related to DeFi. In any case, the authors begin by showcasing the largest cryptocurrencies by staked value. These are Solana, Cardano, and Ethereum's beacon chain. Once upon a time, Terra was second, but let's not bring up too many painful memories. That part comes later too. Yay. Now, the authors then provide this amazing infographic, which shows you the staking rewards associated with some of the largest proof-of-stake cryptocurrencies. As you can see, the larger the cryptocurrency, the lower the staking reward. The authors believe this is because of the lower risk these larger cryptos carry. The authors also take a second to talk about Lido Finance's staked ETH or ST-ETH and how its misuse in borrowing and lending protocols, quote, turns what by design is a relatively low-risk asset into a high-risk one. More about Lido Finance in the description. After quickly explaining how borrowing and lending protocols work, the authors reveal that the amount of crypto being sent to borrowing and lending protocols actually increased significantly at the end of May, though something tells me this has to do with all the loans borrowers were paying back. The authors point out that Aave has remained the most popular borrowing and lending protocol, which really makes me wonder why they didn't label the DEXs they mentioned earlier, because naming names doesn't seem to be an issue here. In any case, the authors also found that around 84% of crypto borrowed from protocols like Aave is sent to other DeFi protocols, with around 38% going to decentralized exchanges. The authors correctly point out that all this leverage can become a problem when the crypto market goes wonky, as we've seen. The 5th part of the Chainalysis report concerns decentralized autonomous organizations or DAOs, and this is the part of the report that made the crypto headlines. That's because fewer than 1% of token holders hold 90% of the voting power across the 10 DAOs the authors analyzed, which are presumably the biggest ones. Obviously, that is not exactly decentralized, nor is it a good thing for the crypto projects these DAOs are for. Now, the authors don't note which DAOs they're talking about here either, but a few come to mind, most notably the DAO for Decentraland, where a whale rejected a series of governance proposals that were passing between the time we shot our last update on the project and the time we uploaded it. Pretty wild. What's worse is that the authors found that the governance requirements of the 10 DAOs they analysed are out of reach for the average crypto holder, with a proposal requiring between 0.1% and 1% of a token's circulating supply to be tabled, and requiring 1 to 4% of a token's circulating supply to pass. As a result, there are only a handful of DAO participants that have the power to table and pass proposals, which is no good for decentralization. As the authors point out, quote, there are several trade-offs at play here. If too many holders can create a proposal, the average proposal's quality may fall and the DAO may be riddled with governance spam. But if too few can, the community may come to feel that decentralized governance rings false. The authors even go as far as to explain what recently happened with Solend, one of Solana's largest DeFi protocols. The TLDR there is that a single Solend whale voted to take away the funds of a Solana whale who was close to being liquidated on the platform, a proposal which was reversed the very next day. Now, while there are many different types of DAOs for DeFi, NFT collections, grant protocols, play-to-earn games, venture funds, charities, and virtual worlds, the DAOs for DeFi protocols hold more than 80% of all the money held by all DAOs, with nearly $8 billion in crypto. What's fascinating is that the most held cryptocurrency by DAOs is the USDC stablecoin, with nearly 60% of DAOs holding the de facto digital dollar. However, only a small percentage of them hold most of their treasuries in USDC, with the average DAO treasury having up to 10% exposure to USDC. The authors speculate that the limited use of these massive treasuries boils down to regulatory uncertainty and the legal status of DAOs, which makes sense. Another thing that makes sense is the fact that most of the funds going into DAO treasuries are coming from advanced crypto users, with more than 80% of DAO funds coming from DeFi protocols. Now, the authors end this section by expressing their excitement about the future of DAOs and highlighting the fact that we all have a front row seat to see their evolution over the coming years. I happen to believe DAOs could eventually replace governments, and you can learn about that using the link down below. Anywho, the sixth part of the report concerns NFTs, and the authors begin by pointing out that NFT-related transactions have fluctuated significantly since 2021 and actually appear to be in a long-term uptrend, despite the recent drop-off in NFT interest. What's insane is that $37 billion of crypto has been sent to NFT marketplaces since the start of the year. To put things into perspective, $40 billion of crypto was sent to NFT marketplaces across all of 2021. Sounds to me like the crypto bear market hasn't hit NFTs yet. Another indicator in this regard is the number of active NFT buyers and sellers, which likewise remains insanely high despite the crypto bear market. What's more is that this number continues to grow, but it may be because long-time NFT holders are coming back to capitalize on some of their gains, if any. What's interesting is that most NFT holders and traders come from Central and Southern Asia, with Africa coming in a close second. Now, I suspect this has to do with play-to-earn games like Axie Infinity, which are extremely popular in countries like the Philippines. You can learn more about Axie Infinity using the link in the description. Now, given the locations of most NFT holders and traders, it should come as no surprise that most are classified as retail, according to Chainalysis's criteria. When looking at this NFT data in terms of transaction value, it's clear to see that most of the actual trading volume is coming from NFT collectors, with a surprisingly small amount coming from institutional investors. The authors note that institutional activity in NFTs hit its peak of 74% in October last year because of the Bored Ape Yacht Club. Note that the authors define institutional as more than 100k in value, which is why lots of Bored Ape Yacht Club activity corresponds to large institutional readings. Those apes are pricey. The authors end this section with a screenshot of Google search trends for NFTs in the United States, which shows a big drop-off in interest, and a question of whether the NFT niche will be able to attract the same amount of interest in the future. Now, the fact that the authors used search trends from the United States is a bit suspect because when you look at global search trends for NFTs, it's clear to see that interest in this crypto niche has completely fallen off a cliff. Looks like the authors needed a bit of copium. The seventh part of the report concerns two NFT-related niches, which are, of course, metaverses and blockchain gaming. The authors begin by dropping a bombshell, and that's that the cost of land in metaverse worlds has increased by almost 9x since September 2019 and continues to rise. The authors attribute this to the fact that, like real-life real estate, virtual land can be monetized. They note access to private events and exclusive communities as the primary reason why the virtual land bubble continues to grow. There's also the prospect of leasing land in the future. Now, if you're wondering where the most expensive virtual land can be found, the authors have got you covered with this useful infographic. As you can see, Bored Ape Yacht Club's other deeds, Decentraland and The Sandbox take the lead with 4-figure starting prices. What's interesting is that most virtual landowners don't seem to hold on to their parcels for too long, save for a few exceptions. As you might have guessed, this is likely because virtual landowners are big fans of flipping their parcels for a profit. I suppose there's not much else you can do with it at the moment. The authors then discuss the possibility of all these metaverse worlds becoming interoperable, including with those created by centralized tech giants such as Meta and Microsoft. The authors cite the recently formed Metaverse Standards Forum as proof that this is on the cards, but something tells me this setting of standards by centralized tech giants is meant to cut crypto out of the equation rather than integrate with it. The authors also state that the success of these metaverse worlds ultimately depends on the quality of the hardware used to interact with them. Virtual reality and augmented reality headsets will be critical in driving adoption, and the authors note that the growth on that front has been close to exponential. As for blockchain gaming, the authors highlight the fact that blockchain gaming activity has increased by more than 20x over the last year. And if you watched our recent video about Cointelegraph's NFT and Metaverse report, you'll know that most of this figure is coming from Axie Infinity. The authors then go through a thought experiment of what it would be like for a centralized gaming giant to get involved in blockchain gaming, and they guesstimate just how much money these gaming companies and their gamers could make by incorporating things like NFTs. Short answer, quite a bit. Unfortunately, the authors don't elaborate too much more about blockchain gaming and instead end the section by not so subtly revealing that they are working with gaming giants to incorporate cryptocurrency for their blockchain aspirations. If you're curious about the top blockchain games out there today, you can check out our video about that using the link in the description. And now, back to the report. The eighth part of the report concerns every crypto holder's favorite topic, and that's safety and compliance. Now, as I mentioned earlier, Chainalysis seems to be pretty tame when it comes to these kind of topics. Case in point, one of the first sentences says, quote, "Operators in the industry associated with that technology need to work to stamp out abuse by bad actors, sometimes with the help of the public sector." Sometimes is the key word here, and I take it as a suggestion that crypto can regulate itself. The authors then present one of my favorite statistics in cryptocurrency, and that's that just 0.15% of cryptocurrency transactions are related to illicit activity. The authors acknowledge this amazing statistic, but stress that there's still some shady stuff going on in DeFi, specifically hackers trying to get their stolen crypto out and money launderers trying to make their ill-gotten crypto clean. As many of you will know, most of the hacks in crypto have been perpetrated against DeFi protocols, though it should be noted that it's not clear whether the authors include flash loans in these statistics. In my opinion, using flash loans is not a form of hacking, it's a form of admittedly extreme arbitrage. In any case, what's crazy is that most of the hackers appear to be from North Korea, with the Hermit Kingdom acquiring over $840 million in crypto since the start of the year, their most lucrative year yet. Now, this is pretty concerning because North Korea is using this money to fund its weapons research. As for money laundering, DeFi is the go-to for those folks too, with nearly 70% of crypto laundering being done with DeFi protocols this year so far. What's funny is that NFTs aren't noted as a money laundering option here. If you watched our video about NFTs and money laundering, you'll know that it seems to be a lot more prevalent than Chainalysis is apparently able to detect. Coincidentally, the next subsection mentions NFTs, but it focuses on wash trading, which by Chainalysis's own account hasn't been all that profitable for its perpetrators. The ninth part of the report concerns another exciting topic, and that's mitigating financial risk. In all seriousness, this section is extremely interesting because it's enormously relevant to all the stuff that's been happening lately. 3 Arrows Capital going under, Celsius apparently being insolvent, Voyager Digital declaring bankruptcy, all that fun stuff. The authors begin by pointing out that crypto has become highly correlated with tech stocks, and that's something I spent a lot of time talking about in our recent video about how low the crypto market could go. That is, of course, in the description if you missed it. Now, the authors take this correlation as a sign that cryptocurrency is starting to mature as an asset class, since the correlation suggests that BTC and even many altcoins are finding their way into institutional portfolios. I reckon we touched on that earlier. The authors then explain how cryptocurrency's transparency makes it superior to the traditional financial system during market downturns, because you can see exactly who's getting wrecked on-chain and what effects this could have on other investors and projects in the ecosystem. The authors argue that the reason why the crypto bear market has been so brutal is because of DeFi, though I would push back against that a bit, as BTC's volatility is roughly where it should be relative to tech stocks. The evidence for the author's argument is that the number of DeFi protocols, along with the amount of money they received, ballooned during the bull market, prepping the stage for a big pop. On the CeFi side, the authors believe that crypto platforms like Celsius were pushed to offer even higher returns on crypto to continue adding new users. And in the middle of a crypto market meltdown, this meant looking for riskier and riskier ways to earn the yield they needed behind the scenes. The authors actually managed to figure out exactly what these crypto platforms were doing to earn this extreme yield on-chain, and yield-generating strategies related to lending came in at close to 40% in the second quarter of this year. That is more or less consistent with what we found in our analysis of Celsius's sudden decline, and you can find that video in the description. The authors end this section by appropriately noting, quote, "Some projects that were hastily built or services that didn't properly manage risk will fail, and that's a natural process for any new technology or industry." Instead of calling for the regulation of DeFi, the authors call on regulators to look closer at centralized crypto platforms and understand how they're using DeFi to assess whether they're operating in a way that's truly in the best interests of their users. Amen to that. The 10th part of the Chainalysis report concerns Terra's collapse, which I'm sure you're all sick of hearing about. But trust me when I say you want to hear this. On the 7th of May, Terra withdrew UST from Curve Finance's 3 pool in preparation for migration to the 4 pool. This reduced the liquidity in the 3 pool, which made it easier for someone to move UST's price below its $1 peg. Note that the timing of this 3 pool withdrawal was not publicly known. 3 minutes later, 2 traders dumped UST into the 3 pool, the first swapping 85 million UST for USDC, and the second swapping 100 million UST for USDC. This pushed UST below its peg, and UST holders started to panic as the crypto market was already in a general decline. Although the authors don't mention this, Celsius was actually the first mover after UST fell below its peg. It pulled $500 million of UST out of Anchor Protocol out of caution in order to protect its users' funds. But this caused even more panic in the markets, leading to a sell-off of both Luna and UST. What the authors do mention is the extensive recovery efforts that were taking place at the same time. 3 unknown whales deposited 480 million of Tether's USDT into the 3 pool to try and stabilize UST's price in the 3 days that followed. On the 4th day, Terra's Lunar Foundation Guard emptied the clip of its billions in BTC reserves, but it was just barely enough to prop up UST's peg until the next day, when it completely lost its peg and began its death spiral down to zero, along with Luna. It's certainly nice to see yet another confirmation of what we discovered on our end about Terra's collapse, and you can find out what we found using the link in the description. Now, after explaining the difference between algorithmic, crypto-collateralized and fiat-backed stablecoins, the authors admit that there isn't all that much on-chain evidence to suggest that Terra's collapse caused the crypto market crash that was going on at the time. The authors believe it's more than likely that BTC's correlation with tech stocks was the primary factor, since tech stocks were simultaneously on the decline while Luna became a lunk. Even so, the authors don't doubt that Terra's collapse did damage to the crypto market. Recall that Avalanche was hit hard. The authors even have some on-chain evidence to this effect, as they found that, quote, hundreds of billions more stablecoins than usual were sold for cash, which is odd given that the market caps of all stablecoins combined isn't that large. Probably a typo. In any case, quote, redemptions peaked across all stablecoins, algorithmic and asset-backed. This suggests that the collapse scared many investors away from stablecoins altogether, not just those of a certain class. The authors acknowledge that USDT briefly fell below its peg, but managed to regain it after it processed $13 billion of USDT redemptions. Crazy how these massive figures are just normal in crypto. The authors conclude the report with, quote, UST's collapse may pose a threat to consumer confidence in the short term and serve as a legislative catalyst in the long term, but it's unlikely to stop the growth of responsible innovation in the industry. Fortunately, thanks to blockchain's transparency, we can learn from these incidents, educate others, and continue to build trust in cryptocurrency. So, this brings me to the big question, and that's what this report means for cryptocurrency. In short, it's a sign that the crypto market isn't in nearly as bad of a shape as crypto prices would have you believe. On-chain activity suggests that the fundamentals for cryptocurrency continue to improve, even in newer crypto niches like NFTs and DeFi. Not only that, but this report was published in the middle of the crypto bear market. Obviously, this report isn't exactly meant to be read by regular folks like you and me. It's something that's meant for more private and public institutions and experienced investors. The fact that Chainalysis wrote this report suggests there's still lots of demand for this kind of crypto content from these entities, and that's pretty damn bullish if you ask me. Either that, or it's a sign that the regulators are coming in and Chainalysis is trying to put out some positive info to prevent a crackdown, but let's not jinx it. On that note, I want to take a second to give a shout out to Chainalysis for putting together such an incredible report. Critical comments aside, this information is extremely valuable to everyone who's involved in crypto, and I cannot wait to cover the next one. And that is all for today's video about Chainalysis's massive crypto report. If you found it as interesting as I did, smash that like button to let them know. If you plan on coming back for more massive crypto report summaries, subscribe to the channel and ping that notification bell down below. If you're looking for more from me, you can check out our second channel called Coin Bureau Clips and our podcast called, you guessed it, the Coin Bureau Podcast. Where do I come up with these names? I'm also active on Twitter, TikTok, and Instagram, and I provide detailed crypto market updates multiple times a day on Telegram. If you're wondering which cryptos I hold, my weekly newsletter is where you should go. It's also where I explain how the crypto market might ebb and flow and what topics I'm planning on covering in future videos. Last, but certainly not least, take some time to check out the Coin Bureau merch store and see if there's anything that suits you for the summer. You can find your way to all of these resources and more using the links down in the description. Thank you all so much for watching, and I'll see you in the next one. Until then, stay cool, stay safe, and stay crypto.